Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. I had the great pleasure to speak with one of my old professors about trading and how to get into trading, how basically to become a master trader. So I hope you like the episode. We talk with Gerard Tong. He is principal at Epitrain, which is his financial markets trading companies. He has 20 years of experience in the financial sector in Singapore and London. He had careers across different areas like trading, risk management, market regulations, and is in trading since 1995. So he has quite a lot of stories to tell and share with us. If you like the episode, please leave us a review on iTunes or wherever you get your podcast from.
For everyone listening, please keep in mind that this is not investment advice, and we have a full disclaimer at the end. But as we got to go into trading, I want to get this out before we start.
And now, without further ado, enjoy the episode with Gerard Tong. Hey Gerard, so happy to have you on. I'm really excited about this episode. You've been one of my absolutely favorite professors during my time at NUS, so I'm really excited to get your views today.
Hey Andreas, thanks for having me on, and yeah, it's very flattering to hear that. I'm glad that I was able to make a bit of a contribution in your journey.
Yeah, absolutely. So can you tell us a bit about what you are doing and maybe explain it to somebody that is not familiar with finance?
Okay. Currently, I'm actually working for a company called Epitrain. There we do training and consultancy. Our main areas of focus are within financial markets and also within business management. Within business management, what I mean by that would be things like finance itself, as opposed to financial markets, as well as project management and some leadership, conflict management, kind of soft skills kind of things. Yeah, I think but it's pretty run of the mill. A lot of people do that. But what makes us different at Epitrain is we believe in immersive learning. There's no point in putting up a bunch of PowerPoint slides, explaining to people, what's a future, what's an option. At the end of it, you walk away, the learner walks away with a definition. So yes, he can regurgitate it and say, this is what it is, but how do you apply it, right? And in the real world, a definition doesn't bring you anywhere. You need to be able to look at a situation, analyze it, select the appropriate instrument, and then apply it to the situation. All our trainings are very hands-on, very immersive. We have been through some of the programs as well. Yeah, we dump you in a situation and everything's happening in real time. And yeah, sink or swim, right? Figure it out. Lose $1 million is fine because it's all fake money at this stage. But once you get to the banks, somebody's giving you an opportunity at an employment. You don't want to be dropping the ball at that point of time.
Yeah, absolutely. I recall the trainings were quite fun. Teach immersive learning. How do you teach someone to figure out the right instrument at the right situation?
I think you need to start right at the top and ask yourself, what is the situation? So the first thing we want our learners to be thinking about is, what's going on? So in financial markets, typically what are we looking at? We're looking for opportunities to make money. And of course, right from the start, then you talk about how do you spot that opportunity, whether you're looking at a fundamental analysis approach or a technical analysis approach, some kind of relative value spread trading, whatever, right? Everybody has their cup of tea. So you pick one of those methods, and then you look for an appropriate position within the market. Of course, then you need to be selecting your products. Typically, I classify products into two categories: linear products and non-linear products. So linear products are where your P&L mirrors the market, right? And you have all the upside potential, but you've got all the downside potential as well. Something like futures, CFDs, all those are linear instruments. Of course, you have non-linear instruments as well, like options, where you can take part in the upside, but your downside is limited. So pick an instrument to express the view you have, which we've taken in step one. Myself, I always prefer to take positions using options rather than linears. And thereafter, once you have a position on, you need to be watching your risk because nothing stays the same. So the other thing we teach our learners about is what sort of risks there are in the market and how you're going to mitigate that risk. And from there, you just keep running your positions, get out when it's time to get out. There's always a happy ending and a sad ending. And yeah, in the words of Journey, some of us will win, some of us will lose, some of us just sing the blues.
How do you make sure that you win more often than you lose? Like you say, there are risks and how to mitigate them, but how do you actually do that?
It starts right from the beginning of what I said about doing market analysis, whether you do fundamental or technical analysis. Personally, I don't really like fundamental analysis. All that is just economic theory. Balance of payments, which country has relative advantage and all that, all those macro stuff. And even if you go down to the micro or the idiosyncratic analysis, is Apple going to do really well? Are they going to launch the next iPhone? Is that going to be even better than all the previous iPhones? I read that the guy who designed the iPhone has just left Apple. So is that going to make the next Apple iPhone a flop? It's very difficult, right? Everyone has a view. Everyone just imagines. And even if you say it's going to be good, so how much revenue is that going to bring into Apple? How is that going to affect the Apple share price? It's all just a dream, right? Everybody throws a number that they want to, and then that's it. And then the guys who happen to guess the correct number get invited back for another interview, and they look like they're gurus and they told the future. But the other 99 guys who made an equally qualified guess but happen to get the wrong number, we don't hear from them. And everyone thinks all this fundamental analysis is magical, but it's not. So for myself, I'm a subscriber to technical analysis. And it doesn't always work, but it gives you a good entry point into deciding what your price levels are. So I always tell people, if you're doing a trade, you need 3 price levels. You need your entry price, you need your take profit, and you need your stop loss. But fundamental analysis does not give you this. They give you an imaginary take profit. They do not know when you're going to enter, and they never ever talk about a stop loss. And one of my key phrases in the market I always tell people is this: he who trades without stops soon stops trading. So if you don't have your stop loss in place, the game will end. On the other side of it, technical analysis gives you or allows you to have these 3 price points. So I'm a firm subscriber to that. But coming back to your point, Andreas, how do we ensure that we make more often than we lose? Actually, the truth is I lose more often than I make. I probably get about 30% of my trades right. I get 70% of them wrong. But the reason I'm still in the game is not about how many trades you make. It is that each time you make, you have to be making a lot more than each time you lose. And then you're going to be all right.
How do you ensure that you that you win higher than you lose?
All right. So again, the sad truth is you can't ensure that, right? So one of the things about markets is this: it's about the whole arbitrage. It's your arbitrage pricing theory, right? Your APT, which essentially boils down to this one truth: in order to make anything more than risk-free rate, you must take risk. So there's no way to ensure, because if you use the word ensure, that means you are sure of it, that if you're sure there is no risk. So the truth is we do not know. It's always a gamble, right? We take risk so that we can earn that market premium. But yet, it is not just about rolling a dice. You can take a calculated risk. So for example, with technical analysis, if you look at a given stock, and you say that the support is at $5, right? And what I mean there is, if you look back at a given time frame, say the last 2 years, the price has never dropped below 5. It touches 5 and then it bounces higher. It touches 5 and it bounces higher. It touches 5 and it bounces higher. So if we're near $5 today, what will you postulate? The probability is going to bounce is going to be a lot higher than the probability is going to drop below 5. And that's where you take your position. So you go long at $5. And if it bounces, then you make money. But if it breaks that $5, so even it drops to like $4.97, $4.95, immediately you know something's gone wrong. You do not know what's gone wrong. As a technical analyst, you do not care what has gone wrong. You don't wait to figure it out. You just say, look, the parameters of my assumption have been broken. If in the last 2 years it doesn't drop below 5, and today it's gone below 5, something is changing. My premise doesn't hold anymore. I'm getting out.
What then do you do if your premise is broken? Do you just try to get out, or do you then reach back to fundamental analysis, for example, to see what's happening maybe with the stock, with the market, with the country, or you just like, hey, I'm just finding a new stock?
I just get out of it immediately, right? Because if you hang around looking for try to figure out what's going on. In the meantime, the market's collapsing and your losses are mounting. And there's this other thing about confirmatory bias, which is one of my favorite topics that you hear me in class about, right? And with confirmatory bias, what's happening is in any given situation, all of us have our immediate reactions, our presupposed outcomes, and we believe there's going to be a particular outcome. For example, if you see the market drop below 5, some of us will feel maybe it's just temporary, it'll come back. And a lot of us will feel that because of loss aversion. As humans, we do not like to lose. The problem with confirmatory bias comes because once the market starts dropping, if you go in search of answers as to why, you will see reasons, but interpret them as temporary and transient. You will believe that the drop is temporary, it's coming back. But the reality is something fundamental has changed. It never dropped below 5, and now it's below 5. So the probability is just going to go a lot lower. So to me, don't wait. The moment it breaks, cut your losses. But that's where the beauty comes in, right? So let's say you manage to buy at 502 initially. Even if you're cutting your loss at 497, or 495, right? You're merely losing 7 cents. Whereas if it bounces from 5 and it goes back up to 510, 530, 550, $6, that's where you're going to be able to get, many times the multiple of your risk. And one of the things I always tell people is, it's not me, right? This is a market belief. The risk reward, it's always 1:3 as a minimum. So if you're betting 7 cents in our example, that's your risk. Your reward needs to be at least 3 times that amount. So at least 21 cents. But of course, if it's going to be 50 cents or $1, then your risk reward ratio is a whole lot higher. And that's why you can afford to get 70% of your trades wrong, but still come out on top.
Is there a difference between trading and investing in that sense? Because I bet somebody very successful with fundamental analysis like Warren Buffett would hardly disagree with your opinions. Or is fundamental analysis something to choose the market and then you use technical analysis to get your free price point that you mentioned?
No, that's a very good question, right? So indeed, yes. To the uninitiated, a lot of times trading and investing are the same thing. But the truth is, if you go a bit deeper, if you're investing, you're actually looking, then as an investor, you need to look a lot more at fundamentals. Is the company producing a product which is viable, it's realistic, it's the start of the product life cycle and all that kind of a thing, right? What are the barriers to entry and all? You want to be looking at things like that. But you are right as well. If you're going to jump in on once you've identified a particular investment, if you want to time the market better, then you need to look at your technicals. So there are a lot of people out there who say you can't time the market. I agree. In the long run, you can't time the market, right? Because you never know what's going to happen. But the reality is that's where alpha contribution comes in as well, right? If there was no timing of the market, everyone with a market portfolio will have the same return. Why do these investment funds that are out there, as you said, people like Warren or other big funds like BlackRock, Aberdeen, any one of those people, why do they all have different returns, even though they have a global diversified income fund? In which case, components of the portfolio should be largely the same. But yet it is when you enter and when you exit. Even if you buy and sell on the same day, you're going to have a different outcome because there's a daily price range. If I happen to buy at the top of the day and you buy at the bottom of the day, the reality is you're still going to make more money than me, even if we're holding the same stocks. So I think you need to think about things like that. I think on your point about Warren Buffett, no fight with the man, right? He is the legend, but we also need to understand why markets move. It's really buying and selling pressure that moves markets. You can do all the analysis you want, but if nobody trades, the market doesn't move. So you can say Apple should be $500 a share today, but if nobody buys, nobody trades, it does not move. So it is really buyers and sellers that move the market after they've done the analysis. So someone like Warren, his sheer size, when he buys, it moves the market. And of course, because he's the legend, he's the, what do they call him? The Oracle of Omaha. So once people hear Warren's buying, what do? They follow. So they jump in behind him, and their buying action pushes the market higher, and then it becomes self-fulfilling. And you look at Warren and say, oh, incredible. I'm not detracting from him. I'm just saying that the price action becomes self-fulfilling.
But what makes people trade?
Everybody wants to drive a Ferrari, man. If all of us were satisfied with the salary we earn and we are going to size our lifestyles to the salary we earn, then why is there a need to earn anything more than that?
That sounds a lot like a introduction to behavioral finance.
Yeah, looks like that will be the next podcast we do, right?
Absolutely. I would love to dive into that more. Can you tell us a bit where you learned all that? So I know you've been a trader at the Singapore Exchange. Can you tell us a bit about the good old days?
Just for clarification, the exchange or exchanges, and not just Singapore Exchange, but all exchanges, do not actually trade, right? The exchange runs the marketplace, but it's really the member firms that come in to trade. So the banks, the brokerages, they are the ones who are actually doing the trades, not the exchange itself. But you're right. I did start my career as a trader, and I started on the trading floor. So back then it was fun, right? We had all these guys in colorful jackets screaming and shouting at each other. And that's really where I began. Maybe if we're talking to students as well here, one of the things really is a lot of people say, they want to get into finance. They want to get into finance, right? Or without realizing there's a difference between finance and financial markets. So finance is about your balance sheets, your profit and loss statement, your cash flow, your EBITDA, your leverage ratios, and all that. Financial markets is all about trading, investing, etc. So let's be clear about the two. But a lot of times people say they want to get into financial markets, because of whatever. And I always ask them, why do you really want to get into this? A lot of times they tell me it's because of the money. Sure, the money is good, but if you're only there for the money, I think very quickly you're gonna burn out, right? It's a very toxic, very demanding, very poisonous environment within financial markets. And if you don't actually like the job, I'm not saying you like the toxicity, but if you don't like the job, you will burn out very quickly. Fair warning as well about people believe it pays well. The days of huge salaries are fading with all this algorithmic trading and electronic stuff coming in. And I think often I'll tell people, beware what you hear. Everybody wants to be a legend. Everyone wants to be a story. So how many times will people tell you their failures, right? More often they exaggerate their successes. How often will people tell you, I'm actually the lowest paid trader on the whole floor? Everybody wants to sound like they are earning $1 million basic, right, and taking home another $5 million in bonus. I'm not saying that doesn't happen, but it doesn't happen to everyone. So ask yourself, why are you coming into financial markets? So for me, I stumbled into financial markets. I mean, in Singapore, we've got national service. So basically, when we hit the age of 18, we have to spend 2.5 years as kind of, I guess, in your side of the world, you call it a draftee or something like that, or conscript. And we spent 2.5 years in the army, after which then we come out and continue with our tertiary education or start looking for jobs. The odd thing was when I was going into, I failed every exam I had when I was in school, right, all the way to high school. So my grades were absolutely nonsense. And when I left high school, going into national service, the idea I had at the back of my head was I was going to become a physical education teacher in school. Unfortunately, when I was in the army, I had an accident and I injured my spine. So coming out of that route, the route of being a physical education teacher was closed. And I had no idea what to do. So one day, it was a couple of days before we got out of the army for good, and we were sitting around a friend's house, and his father comes down and says, "Hey, what are you boys going to do?" And went around the room, I'm going to university, I'm going to Australia to study, or whatever else. For me, my grades were too bad to get into local universities. My father was too poor to send me abroad. And I looked at my friend's father and I said, I've got no idea what I'm going to do. So he tells me, hey, why don't you come over, see what I do? So I went down to the trading floor, which is where he worked. And I came from an arts background. So I majored in geography and literature. I had no idea about finance, financial markets and all. But when I went down, I just saw a sea of people screaming at each other, pushing each other, running around. And I looked at my friend's father and I said, hey, I've got no idea what's going on, but I can do that. And so that's how I kind of stumbled into financial markets. From there, I found that I actually liked it. So I think I was very blessed. I always tell people, you only work for two reasons in life. You either work for love or you work for money. If you work for love, probably you're doing some kind of a charity job or a hobby job. You're not going to get paid a lot. If you're going to work for money, expect to hate the job. The reason they give you the money is a bribe so you will show up. So don't expect to like it too much. But there are a lot of people tell me I'm cynical, right? But for myself, I was lucky. I actually enjoyed the job. And yes, it paid well. So that's how I stuck on in the financial markets. And yeah, kind of without really realizing it, 2 decades passed.
Such encouraging words, man.
Really, I thought it sounded cynical.
What made you sure that you can do this? Like, what skills did you think you have that you needed as a trader? And what skills do you think made you succeed that others may be able to replicate, to learn?
I think in the beginning, right at the start, the 2 basic skills you need, I think one would be situational awareness. As a trader, whether on a lot so on the old days when there was an open outcry trading floor, but even today when we're all seated down in the dealing room, there's a lot of things going on. News is coming out, prices are moving, you aren't watching one price, you're watching many prices. Your colleagues are talking, they're giving you information, they're talking among themselves, you need to glean information off that. Clients are calling in and everything else. So you need to be very situationally aware. Guys who cannot focus on more than one conversation at a single point of time, you're going to have a really tough uphill climb. I think that's the first thing you need. The second thing you need is a little bit of courage and resilience, because it is a very rough environment. People do not ask you things like, oh, Andreas, excuse me, if you're not busy, could you please tell me what last traded price was in the dollar yen, if you're available for that? They don't, right? They just come up and say yen. And if you do not answer immediately with the last traded price, you will feel the wrath of God coming at you, and then you lose the client. But a lot of people can't handle that kind of a pressure as well. So I think right at the start, that's what you need to even get on board, right? You need that situational awareness and you need that resilience. I think as time goes by, then you need to develop your skills. And I think the 2 big skills that, yes, your technical skills are fine, right? Study, go for your CFA if you think that works out for you. Go and learn your fundamental analysis. Go and learn your chart patterns for technical analysis. All those are technical skills which are easy enough. If you apply yourself, you put time into it, you will learn that, right? But as a trainer, we always talk about 3 things, the three things you need. There's always knowledge, skill, and attitude. So you can read a book on technical analysis. That will give you knowledge. But knowledge is useless, right? You can't actually do anything with it. So what you're going to need to do is apply it. And that's where you practice it and you develop skill. And skill is useful in the real world. And for skills, I would say what you really need is 2 things when it comes to trading. The first is discipline. So discipline starts even before you enter the position. Are you going to be disciplined enough to do your analysis completely? Or are you going to be lazy and say, all right, it looks about right, I'm going to go? Discipline next kicks in when you're about to take your position. Are you going to say, oh, I'm bored, let's just buy now and see what happens, it's close enough to my entry point anyway? Or are you really going to wait for your entry point even though you can be sitting there for hours? But I think where the most important part, discipline, kicks in is when things go wrong. Because when the market crashes, as we said earlier, it's 495. You need to cut your losses. Will you have the discipline to cut? And all too often I've seen traders, they will fail. At 495, they'll say, let's wait a moment, maybe it will bounce. At 490, they start to say, let's see what happens now. At 480, they say, it's really cheap now, maybe I should buy a bit more to average. Then at 470, they start praying to God. And trust me, when you start praying in the market, it's over, right? I believe in God, but God does not trade the markets. And suddenly your risk reward has gone wrong. You were supposed to lose 7 cents, but now what are you losing, right? You're losing in excess of 30 cents. The whole risk reward has gone wrong, which we were talking about earlier. If you're only going to get 30% of your trades right, then this doesn't work out for you. So discipline is very important. Indeed, discipline actually applies on the upside as well. All too often, so even, one of the things we always tell our learners is this: plan the trade, trade the plan. Because before you have a trade, before you have a position, you're never emotional. Your plans will be logical. But once you have a position, then emotions come in, and emotion clouds judgment. And eventually you will find that you'll start making on-the-fly decisions, which you think are very smart at that point of time, but it's just because you're emotionally unstable at that point of time. So if you think to yourself, hey, I've got a 7-cent risk, we're going to do a 1:3 risk reward, hence I need this 21 cents. Yeah, and then, you don't force a fit on the 21 cents, right? It needs to be a genuine profit potential. But if you find that the market has gone up by 10 cents and then it starts to stall there, very often our temptation is to say, all right, let's just take profit now. Let's not let it crash from here, right? One of the things we always say in the market is let your profit run, but don't let it run away. And so you start to panic, and then you say, all right, fine, I'll take profit now when you sell. But what have you made? You've made 10 cents as opposed to the original 21 cents. Your risk reward, instead of 1:3, is now 1:1.5. So you've violated all your principles. So discipline becomes, I think, the key attribute you need. The other secondary attribute I would say is courage, because markets don't move in a straight line. You could face a situation where the market dips, it hits your stop loss, say at 4.95, and then it bounces back up above 5. And if that happens, you must have the courage to re-enter the market, because it can be just a false break. And this time it will carry on up. You'll make your 21 cents, which is enough to pay for the 7-cent stop loss in the first round. So discipline to cut, courage to re-enter. But overarching all of that is what I said about situational awareness and the ability to cope with pressure.
How do you test something like that? Now, I know you help companies with recruiting sometimes. How do you, A, test for that? And B, how do you try to learn those kind of things if you want to get into trading?
Well, okay. A, how do you test? I think that's what's going wrong with a lot of recruitment right now. Imagine you bring a candidate in and you ask him, are you situationally aware? Of course, he's going to say, yes, I am, right? If you ask him, are you disciplined to cut your losses? He's going to tell you, of course I am. Problem with interviews is too often when the interviewer asks the question, we know what's the answer. We know what we're supposed to say. The question becomes pointless. So one of the things we've been trying to do is, so Epitrain has its own trading simulator, which, it replicates the entire look and feel of the market, right? When we were doing the beta test before we even launched a simulator, we had 2 traders one from a Singapore bank, one from a French bank. They both came in to trade, and at various points, they kind of put their hand up and asked me and said, hey, this is not real, isn't it? We're not actually losing you any money here, are we? And I loved that, because if the professional traders cannot tell what is real and what's simulated, then you know your simulation feels real. So what we do with this trading simulator is we kind of put people in front of it, and then we run the market. Right. So they put on the hat of a trader for the day, and we just observe. I love this when I saw him at one of the university sessions. There was a young man who had no financial market background. He didn't even come from the business side of things. But at some stage while he was trading, we triggered an earthquake. So the news came up, and watching from behind, you could see, I don't know, man, maybe 80% of the class did not even see the news. He was one of the few who saw that news. And he kind of realized if there's an earthquake on, stock market's going to crash. So he needs to cut his long positions and turn short. So now that is something which is observable. For the other 80%, they can say, yeah, I'm very alert, I'm very aware. Nope, your behavior did not show me that. This guy proved it through behavior. And what was very interesting was he stood up, he raised his hand, and you could see his mouth open, but nothing came out of his mouth. He sat back down and started hammering on his keyboard. So from the admin terminals we have, we can actually see what people are doing at any given point of time. So I was looking at him, and what I realized he was trying to do then was cut his long positions and turn short. And only after he did that did he stand up again, raise his hand and shout at everybody, hey guys, did you see the news on the earthquake? And of course, from there, everyone saw the news because he had alerted them to it. And they started selling and the market crashed. And of course, he pocketed a nice profit. So if you look at this situation, not only did he spot the news, which proves he is alert and situationally aware, but he has got this native cunning within him. He kind of realized if he shouts that out, then he tries to sell, everyone is selling at the same time, he might not get a good price. So he knew, get a good price first and then shout it out. So if I was still trading back in the banks, I would have hired him in a flash. Forget about whether he has got a business degree or anything like that. He has got these native traits, right? So to your point about how do you train this, it's tough. There's a whole nurture versus nature kind of thing. And If you've got a candidate who already has it inherently, you're done. But for those who don't have these inherent traits, I think they can be developed. But again, you're not going to develop this by reading a book. You can't get more situationally aware by reading a book. So here is, earlier I was telling you what the company does in terms of financial markets and business management as our focal points, our focal topics. And I was also talking about our delivery mechanism, right, being immersive and engaging, activity-based. But one of the approaches we like to take is on adventure learning as well. So we take people out of the classroom, put them in the jungle, put them on a rock climbing wall or something like that. And the reason we do things like that is by putting them in these sort of situations, it really requires them to focus, right? If you're on a rock climbing wall and you forget to secure yourself, there is going to be an impact. So this is where you sharpen people's minds. It's not about financial markets anymore. It's just about training their minds, training their resilience. And then you can overlay the financial market knowledge and skills onto that, and they will become strong candidates.
As we have a lot of listeners that study at some very prestigious university, I mean, you're a professor at two very prestigious universities in Singapore yourself. Is there any way that those students actually have a higher chance of having those skills, or is this something that is totally independent of, say, education? And as a follow-up question directly, how much value would you say then have those educations if they don't get you this particular skill?
Right. All right. What is education about? I think education, yes, in some cases, we are learning the skills we need. So if you're going to become a brain surgeon, you need to go through the university to be able to learn the skills that are required. A lot of other roles, you're learning how to learn, right? Especially if you're in tech today. By the time you graduate, whatever you started learning is obsolete by the time you graduate. But you're learning how to learn, not learning the thing, it's the particular coding language per se. And I think if we come back to the issue of, as such, how valid or how important a university degree is, it is important. I think, especially in Asia and especially in Singapore, it is the first sign or symbol that you have put in some effort and you have a bit of a brain, you can understand things, you manage to get through the exam. But as I said earlier, knowledge, skill, and attitude. What does that degree show? It shows you have knowledge, maybe a little bit of skill. It says nothing about your attitude. And I'm sorry to say, but a lot of the young students I meet or the young graduates I meet, when they come out and you offer them a job at a decent starting salary for whatever the industry benchmark is, they turn it down. They look incredulous. They're like, oh my God, is that all you're going to pay me? I've got a university degree, I deserve better than this, right? But the world doesn't owe you a living. You start somewhere. But and that's what I mean by attitude. And once they come in with that sort of an attitude, the entire contribution, the willingness to learn, the willingness to get involved is all very different. But nonetheless, yes, having a university degree gives you a good starting point. So, don't drop out, keep going, right, for the guys who are still studying. It's interesting that you're talking about how people who don't have degrees or anything. So like myself, when I first started out, I didn't have a degree, right? I had a really, really poor high school leaving cert, and that was it. And I was very lucky that, I guess back then, the industry, yes, of course, everyone wanted somebody with a degree, but they're still willing to look at people who didn't have a degree. And I was lucky that my friend's father, whom we spoke about earlier, turned out to be somebody with a little bit of clout. So when he made a recommendation, there were people who were willing to give me a chance. Yeah, but thereafter, you sink or swim on your own, right? But at least he gave me a jump in. And recently I worked with a program. It's called the Tangent program. And what was very interesting in that program was, at the start, what they did was to run some psychometric tests. They have a proprietary system of their own, but they identified candidates who had the right attitudes, but not necessarily the correct academic qualifications. And they got these people on board. It was a cohort of 8. Very, very varied profiles in terms of education, in terms of age, all factors of background. They're very, very varied. And so they got them together and gave them an opportunity within a hedge fund. And they've all been doing well. So what they realized was, with the attitude, they didn't actually have the financial market knowledge. And that's where I had the honor of working with them. So we ran sort of a boot camp program, 8 solid days spread over 2 months. And that's where we armed them with all the financial market knowledge and skills. So we said, you start them understanding what products are, then you put them in situations where they have to apply those products. And I'm happy to say they're coming to the end of their first year, and most of them will be securing full-time positions, is from what I understand.
So you think this is mostly due to the attitude that they got, and they also showed that they are fast and willing learners to be fit for the hedge fund? Because usually for many of those students, like starting in a hedge fund is like it's like the Champions League. It's the top of the game to get there. Everybody studies, and they believe, hey, you got to be an A+ student, and you have to have the perfect CV, the perfect record, everything perfect to get in. But actually, it's a lot about attitude.
Yes, entirely so, right? So, but I think not all employers are that enlightened yet, especially not in Asia. The large majority of the employers still look at CVs, look at your past work experience, and they're just very short-sighted about things. So here, indeed, I think for the Tangents, their attitude, their openness, their hunger to learn, and the drive really brought them forward. Because you can give the best opportunity to a candidate, but if that candidate does not want it, or does not have the cognitive ability to do it, it isn't going to happen.
Do you think all the skills that we lengthily talked about now, are they still relevant in today's electronic or algorithmic trading world, or do we need other skills to nowadays succeed?
I think it's the resilience above all that needs to succeed, that needs to stay. Some people will tell me situational awareness is a little bit less because now, we don't sit inside the dealing room. I don't have to listen to 50 people talking. The machine does it for me, Well, okay. But yet, has that gone away, or has it merely evolved? Because what can a machine do? Yes, we like the idea that machine learning, eventually they'll take over the world, and, Arnold Schwarzenegger will come and save us from them and all that. But the reality of machine learning today, it's still, we have to define a problem, show them winning moves, and then the machine might be able to join the dots between them. Without that input, it cannot actually learn. So we may not sit in a dealing room anymore, but what are the inputs that we need to put into the machine? So like right now, what's going on in the world? Trump's going to some G20 meeting and bagging everybody, a friend and foe at the same time. What's going to happen there? Is that an input we need to put in, right? What are the kind of semantics and the words that he's using? You still need to be aware of all these things. What are the core relations that we see? If we can't even begin to put that into the machine can't learn it. So I think the core skills remain the same. It's just maybe the nature of application has evolved a little bit.
Do you have any tips for people that want to get into electronic trading on how to develop those skills, and maybe also above the attitude, beyond the attitude? Say they have the attitude, what should they learn? What kind of degree, or should they do a CFA? Should they try to do extracurricular activities like trading on their own? Is there anything how they can develop those skills on their own?
Sure. I think all knowledge is good. So if you want to do your CFA and all, definitely. And it helps the CV for sure. But if you're going to be able to gain the same amount of insight without taking the exam, that doesn't change the quality of your mind. Though it does, as I said, does not look as good on the CV. Key things I would say about algorithmic trading today would be, it's all about regression. You can come up with any idea you want, however ridiculous it is. Every time my neighbor's cat is seen sitting on my front porch, when I wake up in the morning, I'll go short dollar yen. Fine, whatever. But you just need to be able to backtest that and see if that works. The problem, therefore, then becomes, how do you not manipulate, right? Because we aren't doing data fitting, but how do you work data sets? How are you going to do your regression models? What are the peripherals we need to handle? So not only do you need to know how to handle the analytical stuff, are you able to program that in Python or C++, or even just simply in Excel so you can get an output, or you're going to rely on somebody, time to market becomes of essence. So I think in terms of hard skills, those are two areas you're going to need. Some analytical skills and also some programming skills.
How do you make sure that, you've backtested an algorithm, and because your cat is sitting on the front, or your neighbor's cat is sitting on your front porch when you wake up, and then even your backtest runs out to be correct. So how long can you use this algorithm? Is this going to make me rich, or...
I was thinking there was one more point I wanted to raise, but it kind of slipped my mind. But that's exactly it. Thanks for asking the question. The reality is this: you can find any data that might support a view. But I think there are two things we need to worry about. One, is it a coincidence? Because coincidences can perpetuate for a while. And if we are looking at that data set where the coincidences are perpetuating, then indeed I'll go short dollar in every time I see my neighbor's cat on my porch. But actually, there is no logical relationship there. But even if you say there is a logical relationship and the backtest results hold true, you must understand that what drives the markets, I think I touched on this earlier, what drives the markets really are buyers and sellers. But that community of buyers and sellers continually change. Think about the markets 20 years ago. What was the community? It was me and my friends. Of that community, within my friends, I think there are only about 2 of them who are left on the trading desk somewhere. All the rest of us have moved on to other things. So new people come in, the environment changes, the behavior changes. So even if your backtest results hold true today, you must be aware that they will change. So one of the things about algorithmic trading, and I borrowed this from project management, right? The final step after you've done all your analysis is you execute. But after you execute it, you have to monitor and control. So regression is not a magic bullet. You do it once, you find a formula, and then you apply it for the rest of your life. You have to continually perform regression again, because every day there's new data coming. You have to decide, is my model still holding true, or is it beginning to veer off course? And if, for example, if we're going to get 3 or 4 losses in a row, where that has never been demonstrated in the past, then is it time to press pause on the algorithm and reassess?
Awesome. I love your insights, and I would love to, at a further point, jump back deeper into electronic trading, into behavioral finance. So I hope we will have the time to chat again. But for now, I want to be respectful of the time. You've been very kind with your time and your insights. Is there anything, any last words that you would leave your audience with, anything that you want to get out to people, and any last tips, maybe favorite books, some experiences that you want to share?
It's funny that I mentioned I majored in literature, but I've never read a book cover to cover in my life, except for one. So when we go for exams, how do you prepare for a literature exam, right? You read a little bit of the book, and then you buy a study guide and you read the study guide instead. But the one book I read cover to cover was The Old Man and the Sea. And I often talk about that in class. So for those of you all who have never read the book, go and read it, right? It's a very easy book. No surprise, the storyline is about the old man and the sea. But read that book. I always ask people to think about, what is the moral of the story? So I'm not going to tell you what my interpretation is. Read the book, and if we get to meet again, then we'll discuss that further. What I found interesting is that generally there are 2 groups of people. There are 2 main interpretations of that idea. And what I have also started to theorize, though I don't have enough data, is that one group's interpretation, or the group of people who subscribe to one of the interpretations, will never make it in financial markets and never make it in trading. So read the book, and we'll talk again.
All right. I hope I will get the correct interpretation so I can make it in financial markets. And I bet a lot of our students will be curious at one point to know what's your interpretation. So I hope to have a follow-up with you soon. And then I'll leave you to the rest of your weekend. Thank you so much for being on the podcast, and I'm looking forward to meet you again.
Not at all, Andreas. Thank you for having me on board. It's been really fun.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com to see what we're up to before anyone else. Subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.